Hi, my name is Ernie Burns, CEO and President of Burns Estate Planning and Wealth Advisors. Let's face it, this is going to be a webinar that's very unique because we're going to talk about something we've never talked about before, how your investments will react in a pre-election, post-election era with a worldwide virus that attacked the United States as well as 150 other countries in January of this year. That being the case, we've seen a massive stock market crash. We had the strongest stock market in 30 years, the lowest unemployment in 50 years. And what do? We turn the engine off. This economy, we didn't have a dot-com bubble back in 2001. We didn't have a mortgage crisis in 08, 09. We didn't have a financial crisis. We had basically just turned it off because of a huge black swan event. Now we have an election that is basically pondering the market around and punching it around in a variety of different ways. The bottom line, a lot of people's investments, their retirement accounts are getting beaten up because of this. Is your advisors proactive or reactive? And what do we mean by that is this. Have they basically looked at your portfolio and made the necessary changes for whoever's elected? One president is looking at lowering taxes, more pro-business, more basically focusing on you for saving your own funds. And the other category, they're basically looking at a standard to increase taxes and basically make everybody stand on their own feet with government help. So where does it look like you're going to be focusing inside your investments and how they're going to react? So we're going to talk about a few different things today. Is your advisors proactive or are they reactive? Have they focused on this market in a manner of you have a balanced portfolio? You're going to be okay. Now, if you're 30, 40, 50 years old and you're not retiring anytime soon, you might be okay. That's true. You can be buying shares cheaper as this market basically turns into a roller coaster or has turned into a roller coaster this whole year. However, if you're 50 plus and you're looking at retirement in the next few years or you're currently retired, you have to be a little careful. In some instances, very careful if you supplement your income from your retirement. So what we mean by that is this. If your advisor is basically having a bunch of mutual funds, then you're buying those shares cheaper if you're younger. However, if you're older and you supplement your income, maybe not the best place for you because inside that mutual fund, you might own United Airlines, Delta Airlines, and Marriott. All good companies, not doing well and not going to do well for a while in the world that we currently live in an economy that's basically focused on consumer spending. Then you have the other sections. You might also own Microsoft, Apple, and DocuSign in the same mutual fund. So that mutual fund's been stagnant and you're not getting a lot of return from it whatsoever. However, if your advisors are proactive, they're going to focus on sectors of the market that are doing really, really well. And what we mean by that is possibly individual stocks, blue chip dividend stocks that are focused in this market that you have more control over. When you have more control over, you can fire and hire a stock or a bond much quicker than an actual mutual fund because of the factors how they basically are built. So, are your advisors proactive or reactive? Do they have the same type of investment philosophies? And they should not have the same philosophy. You should not be in the same model as a client that walks in a door at your local brokerage company that is 25 years old, as a client that walks in a door that is 60 years old. If they're offering the same type of products to the same individuals, might not be the best advisory for you. My advisors here, Burns Estate Planning and Wealth Advisors, we focus on strategies in the market that are going to benefit clients pre-retired and currently retired. We're going to focus on income, Social Security, and investment sectors of the market, individual stocks and bonds in the market that are going to do better for you in a volatile market or in a settled bull market. That being the case, it's a win-win for our clients overall. So we sit down with the client, what we're going to do is start looking at your goals first in retirement. Whether that be travel the world, spending more time with your children, spending more time with your church, or hunting and fishing all day. Whatever it might be, it takes different income necessities to do that. So therefore, that's a retirement plan built individually for each specific goal. So then we look at strategies to accomplish those goals. And then we have all the license for the stocks, the bonds, and mutual funds and annuities out there That is the tools. A lot of times we sit down with clients and they're looking at their portfolios, and what they've always been told is you have a balanced portfolio, that's your retirement plan. That's not a retirement plan, that is a tool. We actually build your retirement plan specifically for your goals and your wishes and desires. Next, we're going to talk about something very unique, is tax strategies. Now, no matter who you might be voting for and what your personal beliefs are, what we're going to talk about is policies for a second. One president wants to lower tax bases and lower income taxes and lower capital gains taxes. The other president, which is Biden, wants to basically raise taxes in general and raise capital gains taxes. That's going to defer and deter long-term Wall Street. That being the case, how is your portfolio set up to basically deal with this? That's what we focus on. So make sure, what we basically do is we make sure that all your assets are not going to be taxed in that manner. We focus on tax strategies to reduce your tax obligations to the IRS. And what I mean by that is your 401ks, your 403bs, your IRAs, your retirement plans. Now, let's get into our options. One thing we want to add in here also, you can ask a question at any time during this event. We have a financial advisor on standby to answer your questions. So just type those questions in, we'll get them answered right away. Okay, so we have 3 industries to invest through inside the United States and pretty much around the world. These 3 industries are some basic stuff here: banks, Wall Street, and the insurance industry. Well, let's look at banks first. What options do we have for investments? We have checking, savings, money market accounts, and CDs. Typical things, right? Banks are really not meant for investing anymore. They're really meant for liquidity, access to your money when you need it. Banks haven't paid interest since pretty much the late 80s. How about the Wall Street bucket? You have stocks, bonds, mutual funds, REITs, basically commodities, and then variable annuities. All have a risk, but all should be getting good rewards, and there's a variety of fees built into them depending on what you're doing, and there's other investments inside the Wall Street buckets. Then we have the insurance industry. You have fixed annuities, index annuities, and life insurance. All insured products, and some that have other tax benefits built into them. Now, inside these industries, you have options to invest in different ways. Tax strategies are key, because these tax strategies are going to be big for the future for you, which we're going to get into a little bit more detail. So, here's what we are doing. Basically, we make our money from our jobs, from our employers, okay? And we basically have our money in our checking savings as we get paid, and we invest that into our investment accounts, our retirement accounts, wherever they might be, into stocks, bonds, mutual funds, and however we might do that. Then from here, what we're going to basically show you something a little bit different. We're going to show you how to get from a taxable account to some tax-deferred and tax-free accounts, maybe some insured accounts. Because truly, most of us out there, if you think about it, have our investments in stocks, bonds, mutual funds, overall market type of products. So let's look at a different bucket case, in a sense of where our investments have opportunities in an industry and a government where we have taxes that basically rule this country. The more you make, the more you pay. Not like the media talks about, the more you make, the more you pay, unless you've done some type of tax planning. First bucket is the taxable bucket. Taxable is in CDs, mutual funds, bonds, REITs, stocks, dividends, and other instruments that you can basically have to pay taxes on. The tax-deferred buckets, your qualified retirement plans. This is your 401ks, your IRAs, your 403bs, your SEP/KIAs, your lasers, your drop plans, whatever type of retirement plans you might have. Non-qualified annuities and savings bonds. Those are tax-deferred. And then you have tax-free investments. Municipal bonds, Roth IRAs, and life insurance when used properly. This is what I want to get into a little bit more differently, in the sense that most people are not aware of these other instruments that you can use. That being the case, what we're going to show you now is something that E.F. Hutton came up with in the 1980s. Those of you that are old enough out there, probably most of you, remember when E.F. Hutton says it. When E.F. Hutton speaks, people, That's right, and listen. He came out with a strategy back then. It says, what if you basically did this? What if you limited the life insurance that somebody would take instead of basically trying to sell them the most life insurance as possible? By and large, this. Most people look at life insurance as a death replacement, an income replacement at death, God forbid, and is widely used for that, and it's quite useful. But EF Hutton came out with a different idea. What if you funded the life insurance to the least amount of life insurance as possible, because it's regulated by the IRS, which are life expectancy tables, to legally call it life insurance. Whereas put most of your premium, most of your money into the investment side of that product. Now, like I said, this is a unique strategy that many advisors are not talking about because either their client base is too young or they're not licensed in that field. And here's what I mean. Let's say, for example, I'm going to give you two examples, one 40-year-old and one 60-year-old. The first, the 40-year-old, you're still working. You have children in college by now, or about to go to college, and you're saving inside your retirement account. But inside that retirement account, you're saving and you're kicking a can down the road for taxation. Here's what I mean by that. I've been doing workshops and seminars for over 20 years, and I ask this question to every single couple. And truly, 99% of the time, the female answers the question in this manner. When I ask, when he passes on, what income would you like? And her answer is always the same income as I have now. Why? Because you get used to the standard of living that you're living in now. Therefore, you don't want your standard of living to go down because your spouse passes on. It completely makes sense. But the first thing that happens is a few things. One, the first thing is you go from a joint tax bracket to a single tax bracket. So your tax bracket goes up. You also lose an income. If you're over 62 and a half, you might be drawing Social Security, and one of those Social Securities will be dropped. So where do you draw that money from for an income replacement, as well as you want to make sure that your standard of living doesn't go down and pay more taxes? Well, most people basically go to their top retirement accounts, their IRAs, their 401ks, their investment accounts. The problem there is, guess what? Every dollar you draw out of a retirement account, it's taxable. There's another way to do it. That's what we're going to talk about here today. So that 40-year-old or that 60-year-old, let me talk about the 40-year-old first, decides this. He sits down with us and looks at a different plan. And this is where, now, what's popping up on the screen now is an illustration. This illustration is performed by Allianz Life. Allianz is the oldest one of the oldest insurance companies in the world, and they're the second largest in the world. This strategy is not meant for everybody. This strategy is meant for a situation that we would have to sit down with you to see if this is suitable for you. The unique thing about this is, though, and this is why I actually have this personally, once you put $1 in, you're never taxed again, however this money comes out. So the strategy goes in, you put in $500 a month, which is $6,000 a year. You would instantly have a death benefit of $172,000. Ideally, remember, the goal here is not for death benefit. So this is the least amount of life insurance as possible. The goal here is for tax-free income when you draw this money out. You decide to do this for 25 years, so when you're 65 years old, you put in $150,000. Now, you decide, and this is the goal behind this, you activate income. When you activate income, as you see here, at 66, you retire $33,756 a year, tax-free. So the strategy works like this. So therefore, when you put $1 in, it's never taxed again. That's the goal behind this strategy. It's never taxed again. So therefore, for the next, whether you die early, then it's a life insurance policy. God forbid, if you look on here, you die at 60 years old, the heirs, you put in $120,000, the heirs get $383,000. So the goal is to double or triple the money without risk associated with your investment. But more than likely, you activate the income, and while you and your spouse are here, you start traveling, doing the things you want to do. But the goal here is to have money coming in that's not taxed, because we don't know what the future tax rates are going to be, who's going to be president. So the more you have lump sum that is tax-free, the better for you and your family. And if you die early, there's a death benefit. Then we go to the next page that shows you, more than likely, you will live, let's just use a round number of 85 years old. At 85 years old, you have now drawn out well over $500,000+, right at $600,000, right at $600,000, and you have a death benefit of $240,000. So now you put in $150,000, and you've drawn out with a death benefit over $700,000. In 4.5 years, the money you've put into this investment, you have now taken out. So when you activate it at 66 years old, as long as you live to be 70, then you've actually taken the money out that you put into it, and you would have a death benefit of double that. So no matter what you do in this investment, you double your money tax-free. So whether it comes out as income, which is your goal, or whether it comes out as a death benefit, which eventually it will in some fashion, just a different amount depending on how long you live, it's a win-win situation for you. Now, is that meant for everybody? I don't know. Let's look at the next one, okay? Let's look at the next one. Somebody that's a little bit older. Years old. He has $500,000 to invest, and he's going to do it as a lump sum. He knows he's not going to use this money. The idea is to draw this money, in my suggestion, out of a retirement account. You draw it out of a retirement account, therefore it's less taxes down the road the IRS can basically draw out. So let's just look at a $650,000 withdrawal out of an IRA or a retirement account. So it's an even $500,000 after tax dollar net. You deposit this into the same product at Allianz. We deposit it into that product, and from here, Allianz cannot accept it, and this is why you have to have a certified person to do this, as a lump sum, because it would make the plan be a modified endowment plan. So therefore, when you draw money out, it's taxable. Well, that defeats the purpose of the plan. So what we would do here is we would do a deposit route built into the plan, and they actually give you a little bit of a bonus on that, as you see here. At $30,188 at age 70, you will see the outcome there, but it's actually given to you a little bit every year. That deposit router pays the premium. So you would deposit the $500,000 in, they would give a $30,000 bonus, and that deposit router goes over 7 years. So each year they're depositing from that router activated $75,741 a year. Now the first year you instantly have life insurance of $1,126,000. So God forbid if you died early, you would double your money. Win-win situation. But you take it from a taxable event to a tax-free. Remember, that's the goal behind this. At 67 for 7 years, you've completed your deposits from that rider. So now Allianz is done with that. You put in $500. The value is $530 because of the bonus, because you had to put that into the rider. You activate the income at age 70. That was the requirement in distribution. That's why we ran this. Now, the Secure Act passed in January of this year. Basically said you don't have to draw your requirement in distribution out of your retirement account, so now 72. But let's say you don't want to work quite that long. So let's just use 70 as an example. At age 70, you activate this income. That's $57,084 a year. That $57,084 a year is tax-free. That's equal to an amount of about a little over $70,000 taxable, depending what tax bracket you're in. And let's say you live the same age, 85 to 85 years old. So by 85 years old, you have now drawn out $856,000, plus a death benefit of $408,000. So it's a total benefit tax-free to you and then your family with the life insurance portion of $1,264,000. So again, that a $500,000 investment more than double which average life expectancy. So the goal here with this product and this strategy is this. Once you put $1 in, it's never taxed again. No matter who's elected in the future, your grandfather into this benefit, okay? This product using this law, okay? That being the case, it's a win-win situation for you in most cases. Now, we have to sit down with you, but it's a strategy you've never seen. If your advisors have never talked to you about this because they either not licensed in that field or their client base is probably much younger or of every age. All of my advisors, all of our client base is 50 and over. So therefore we concentrate on strategies to benefit you. Yes, as I said earlier, we do the stocks, the bonds, the mutual funds, and investments. But the big thing about today in this world that we live in is strategies. Income strategies, tax strategies, as well as investment strategies. So therefore we focus on not just selling you a product or selling you an item. It's the big thing is how to invest that item. What strategy do we use to benefit you? As a fiduciary firm, we pride ourselves in this. So we hope you give us a call. What we're going to offer you is this, a 15-minute phone call with an advisor, or we can definitely sit down. We have 5 offices here in South Louisiana. In Hammond, there's our main office, Metairie, Baton Rouge, Slidell, and Mandeville. In addition to, if you're looking at this, you might live in Florida or all the way up to New York. We have clients all around the United States. We can do a Zoom meeting very easy also, and we can still possibly do business if you do qualify. We look forward from hearing from you. Also at the same time, on the right side of your screen, you can post questions, and we're gonna have a financial advisor answer those questions as of right now. Thank y'all for having me. We look forward to talking to you soon.